Indranil Pan, Chief Economist with Kotak Bank, joins us live. Indranil, good morning. Thank you for joining us. For the July IP at Kotak Bank, what are the kind of numbers or estimates you are working with?
Our estimate for the IIP is negative 1.1, and I think in terms of the overall trends, we are not really looking at any significant change with the capital goods continuing to sort of remain in the negative territory, and so is the consumption slowdown continuing to sort of impact the overall industrial production.
Indranil, what is it that you're expecting to see in terms of manufacturing and capital goods individually?
Often I can't really sort of highlight the expectations there, but I think the manufacturing, we are looking at a negative 1.5%. And as I said, the capital goods, yes, there have been sort of pretty bumpy ride in terms of the capital goods indicator. But overall, I think the downtrend in terms of the capital good continues to hold intact.
Indranil, so how long before we actually can see some sort of revival or uptick coming for manufacturing and cap goods in particular, considering as a trend they've been the most beleaguered ones?
I think in terms of the capital goods, we are not really too sort of sanguine about a recovery immediately, because I think what is really plaguing the capital goods sector is also the lack of visibility of demand. The previous cycle of previous investment cycle, or the strong investment cycle between 2003 to 2008, was actually led by extremely strong growth domestically from the consumption side, as also from the external environment, which was also sort of significantly on the stronger footing, which is totally missing at this point in time. And unless there's a clear trend direction that emerges out of the global cycle, that the growth is recovering, will stabilize or recover even further, that could be the only sort of trend changer for the capital goods production in the economy. Now, having said that, I think from the consumption goods side, we could be expecting some bit of an uptake, because what we have been seeing is that the export numbers have been performing better. The currency depreciation has happened. To a certain extent, we are now getting benefit of the currency depreciation, also because the demand side factors from the global environment is looking stronger. So that could actually help the sort of consumption goods production in the economy.
Indranil, if the July IP data is expected to be negative, nothing we know has changed in the month of August, and September again will be a weak month for industrial activity. Can I safely assume that this time around the Q2 GDP based on industrial activity could crack below 4%?
See, as I said, there are certain enablers that we are actually seeing in terms of the export numbers picking up. As of now, we still have a sort of a very flat or a negative number in terms of the contribution of manufacturing to the overall GDP. But having said that, I think the factors that we would constantly monitor is the type of export momentum that we see going forward. We have seen 2 months of positive growth in the export, which is not a mean achievement in the type of environment that we are surviving at this point in time. Secondly, we expect that the fiscal push will continue. We are not really expecting significant contraction in the expenditure side as had happened the last year. If that happens, then again there is a big sort of likely slide in the growth that we can expect. And the third, obviously, we are expecting that the good agriculture that everybody is expecting, that to lead to a second round implication in terms of the industrial production, industrial goods demand. So I think these are the three very crucial factors that we need to watch out going forward.
For a currency trader or for a bond market trader, Indranil, what could be the importance of today's CPI number?
I think let's sort of understand the whole situation in terms of at least the bond markets. I think at one point in time there was a huge expectation that the WPI and the CPI are all coming crashing down. And that's the reason why the market had been expecting a very significant pace of monetary easing by the Reserve Bank of India. And therefore, the new 10-year, when it was issued, cut off at 716 and traded all the way down to 709 also. Now, from that point in time, there has been a dynamic change in the way we would be looking at the CPI and the WPI. the currency depreciation is here with us. The expected softness in the food inflation had not really materialized to the extent that we were all expecting. So in terms of the WPI movement, we are sort of turning the corners, and we had expected the corners, we had expected an uptick from around September, but the uptick has already started. So basically the point that I'm trying to make is that very little scope for the monetary policy to ease from now on, which necessarily means that there would be very little scope for the overall bond trends being on the softer side in terms of the yield. In terms of the currency markets, I think we are more or less at a fair value level. In fact, most of our expectations that we were putting out were 63 to 67 in terms of the currency market, with a broad fulcrum being at 65. So I think we are more or less there, and the next big event is obviously next week's QE sort of tapering exercise by the Fed. More or less the market has factored in that it would happen, but the debate is still on in terms of the extent that it would happen. So I think that's another sort of crucial element that might actually change the direction of the currency markets. But I clearly think that anything sub 62 or a 62.50 is possibly not likely even in the current scenario.
Indranil, so just a word on the currency before we let you go. Does it seem like 63, 64 sort of levels would stay?
I think that's the point that I was trying to make, that the broad sort of range that is getting established at this point in time is around those levels. Now, another clear indication why I'm not really thinking of, again, a huge appreciation of the currency will happen is simply because the inflation dynamics has once again started to worsen. So in terms of the overall inflation gap between India and its trading partners, we would sort of have to watch out in terms of what is the extent of widening that is there. So that's one reason we do not think that the currency appreciation story is here to stay for a significant period of time, and we should be sort of seeing a stabilization of the currency dynamics compared to, say, about a 15-day back when everybody was talking about a 70 and even maybe beyond that. So we are not really looking at 70 at this point in time, but more a stable scenario within the 63 to 65 range.
And then, final question. Do you think US Fed could trump all the argument, whatever case you are constructing, whatever case markets are betting on, 18 September, everything could get reset?
A very difficult sort of point to sort of even debate on. And I think even the Reserve Bank of India doesn't really know what is going to happen on those particular dates. And that's one reason why they have not taken a chance, and they have moved the policy now to the 20th September rather than the 18th September, which was earlier announced. So I think, as I said, that it is sort of a non-event in the sense that tapering will happen. It would be an event in the sense as to what is the extent of tapering. Now, again, we can argue whether it's September is the right date, but whether the next policy meeting of the Fed of October is the right date. But I think the noise will continuously be there in terms of the need and the sort of expectation of the Fed to taper the QE. Again, the point that needs to be noted is what is the extent, and beyond that, given the extent, what is the implication that it is sort of actually having on the US economy, and therefore what is the sort of next roadmap that we need to look at in terms of the QE taper.